Converting from a C corporation to an S corporation is a significant business decision with major tax implications. The right timing and proper planning can save thousands in taxes, while mistakes can lead to costly consequences. To qualify for S corporation status, your business must meet several requirements. You must be a domestic corporation with no more than 100 shareholders. All shareholders must be U.S. citizens, residents, or certain qualifying trusts or organizations. Your company can only have one class of stock, meaning all shares must have identical rights to distributions and liquidation proceeds. The conversion process itself is straightforward but time-sensitive. You'll need to file IRS Form 2553, which is the election by a small business corporation form. This must be submitted no later than 2 months and 15 days after the beginning of the tax year in which you want the S corporation status to take effect. Missing this deadline means waiting until the next tax year, unless you qualify for late election relief. If you miss the standard deadline, the IRS may grant late election relief if you can demonstrate reasonable cause, such as misunderstanding filing requirements or receiving incorrect professional advice. To request relief, you must submit a detailed explanation, along with proof that your corporation met all S corporation eligibility requirements as of the intended effective date. One of the most significant tax considerations when converting is the built-in gains tax, often called the big tax. This applies to assets that appreciated in value while your business was a C corporation. If you sell these appreciated assets within 5 years after conversion, you'll face a 21% tax on those built-in gains. This can create a substantial tax burden for businesses with valuable inventory, real estate, or intellectual property. Strategic timing of your conversion can minimize tax exposure. Converting during periods when your business assets have lower market values can reduce potential built-in gains, tax liability. Some businesses choose to convert before anticipated periods of slower growth, or distribute excess cash as dividends before conversion to avoid complications with accumulated earnings and profits. For former C corporations, monitoring passive investment income is crucial after conversion. If passive income exceeds 25% of gross receipts for 3 consecutive years, while the company still has C corporation accumulated earnings and profits, the IRS can revoke your S corporation status. Passive income includes rents, royalties, dividends, and certain interest income. The tax impact on shareholders also changes with conversion. In a C corporation, shareholders pay taxes on dividends at capital gains rates. In an S corporation, business profits pass through directly to shareholders' personal tax returns. Shareholders who work in the business must take a reasonable salary before receiving additional profit distributions, not subject to self-employment taxes. Common mistakes when converting include missing the filing deadline, having ineligible shareholders, such as partnerships or foreign individuals, maintaining multiple classes of stock, and failing to properly manage retained earnings. Additionally, selling highly appreciated assets soon after converting can trigger unexpected tax bills under the built-in gains tax rules. State-level compliance adds another layer of complexity. Some states require separate S corporation elections beyond the federal filing. Others impose minimum franchise taxes regardless of S corporation status, and a few states don't recognize S corporation status at all, resulting in hybrid federal and state taxation. Converting from a C corporation to an S corporation offers potential tax advantages, but requires careful planning and timing. Understanding the eligibility requirements, deadlines, and tax implications will help you make an informed decision that aligns with your business goals and minimizes tax liability. Working with qualified tax professionals during this transition can help you navigate the complexities and avoid costly mistakes.